Yes. So we started with retirement of a partner, and the first concept that we completed is calculation of what? Calculation of new profit sharing ratio and calculation of gaining ratio, right? Have you completed those two questions, Sadhna? I gave to you and Shivarish. Shivarish said, okay, any doubt in that? Shivarish said, me, please give us tough questions. Okay, Sadhna. Okay. Then calculation of new profit sharing ratio and gaining ratio. So there are different, I can say the levels by which we have to calculate. So first thing is when new PSR is given. I'm just revising what we finished in the previous session. New PSR is given, sir. So when new PSR is given to you, you just have to calculate what? You have to calculate gaining ratio. So what is gaining ratio formula? Gain ratio is equal to new share minus old share. Right, Parsarthi, Sadhna, Dhanashri? Yes. Then second we see when new profit sharing ratio is not given, right? The new profit sharing ratio is not given. Under that, so under that first case we understood only one partner is gaining partner, right? Only one partner is gaining partner. So if only one partner is gaining partner, in that case, gaining ratio is always 1:0. And so how to calculate new profit sharing ratio in such a scenario? So we have to use new profit sharing ratio formula as old share plus share gain. Old share plus share gain. You can calculate new profit sharing ratio. So after that, we completed concept number B, when more than one partner is gaining partner. When more than one partner is gaining partners. Under when there are more than one partners who are the gaining partners, means what? So partner A, B, C are there and C is retiring from the partnership from business. So C share will be enjoyed by A and B both, right? That is nothing but when more than one partner is gaining partner. In such a scenario, so first case will be proportion of share gain is given. So what does it mean proportion of share gain is given? So proportion of share gain is given is nothing but, so in which proportion that partner A and B is going to share the profit sharing ratio of that retiring partner. For example, previously their A, B, C were the partners. Previously their share were 1:1, right? If C is retiring from the partnership from business, then his one third share will be enjoyed by partner A and B. But sir, in which proportion they are going to enjoy? Sir, it is given in the question, right? So if it is given in this question, we have to follow the steps. So step number 1, calculation of share gain. Calculation of share gain. How to calculate share gain? Simple formula is there. You have to start with retiring partner share. Retiring partner share multiply by proportion. You have to do for both the partners, right? Both the old partners. Retiring partner share multiplied by proportion of share gain. proportion of share gain, you can able to calculate what? You can able to calculate the profit sharing ratio for, or I can say share gain for that two partners. So after that, so step number two is calculation of gaining ratio. So how to calculate gaining ratio? So your gaining ratio is nothing but numerator of your share gain. Numerator of share gain is equal to gaining ratio. Right? This is step number two. And then step number three, finally we have to calculate new profit sharing ratio. Step number three, calculation of new profit sharing ratio, and formula is new profit sharing ratio is equal to old share, whatever old share of that two partners, plus share gain. Right? By following these three steps, we can able to calculate what is gaining ratio as well as what is new profit sharing ratio. So after that, there is second scenario under which under the case of when one partner is gaining partner, when more than one partner is gaining partner, under that we completed first one, proportion of share gain is given. I've just that. And second scenario is more than one partner is more than one partner is a gaining partner, but proportion is not given. Right? Second case is proportion in which they are going to share. Proportion in which they are going to share gain is not given. So if it is the case, then their old share, the old share between that remaining partners, I'm talking about the share between that remaining partners. For example, if partner A, B, C is there and their profit sharing ratio is 1:2:3, right? If C partner is going out of the business, then only two partners are remaining now, partner A and B. So we have to see only their profit sharing ratio among themselves. In the case of proportion in which they are going to share, again is not given, sir. So their old share is 1:2 only between themselves. So their old share between themselves become their gain ratio as well as become their new profit sharing ratio. No need to calculate any gain ratio or any new profit sharing ratio. You have to simply see here the remaining two partners A and B are there, and proportion in which they are going to share these C partners profit sharing is not given in the question. Then you simply have to see their both the partners share, that is 1:2, and that their old share becomes their gain ratio as well as their new profit sharing ratio. Right? So I have completed this concept in the previous class, and we solve questions as well. Right? Have you I've given one class assessment for the same. If you haven't completed yet, Parth, Sarthi and Dhanushri, then after watching the record sessions, you have to complete the same, right?
Okay, sir.
Yes, Sadhna, Parth, Sarthi. Okay. So I have just this is what we have done in the now we have to see what we are going to see today. See, adjustment for revaluation of assets and liabilities. So this adjustment is similar to adjustment that you studied in admission of a partner. In admission of a partner also, we used to prepare one account called revaluation account, right everyone? Revaluation account. So revaluation account is as good as your profit and loss account, right? Is as good as your profit and loss account only. So on the debit side of revaluation account, we have to calculate or we have to write down losses and expenses. And on the credit side of revaluation account, so we have to write down profit and gain. But sir, this profit and loss is out of revaluation of assets and liabilities. So what we have to do exactly? Sir, it is as per the Partnership Act 1932. Whenever there is admission of a partner, whenever there is a retirement of a partner, you have to calculate the current market value of your asset and liability on the occasion of retirement or on the occasion of admission of a partner, right? So today, if C partner is going out of the business, so on this scenario, because of he is going out of the business, it is a mandatory on your part that you have to calculate your true value of your assets and liabilities today, right? So whenever you calculate asset and liability value today, but obviously there is a change in your book value, right, that you recorded previously. For example, 5 years back when you purchased one furniture, you purchased that for rupees 50,000 and you have recorded for 50,000. So but obviously the value of that furniture is not same today. It will be different. For example, it is rupees 20,000, right? That means your asset value get decreased by rupees 30,000 here. Same way, 10 years back you borrowed a loan of rupees 10 lakhs and the loan period is of 20 years. So over a period of time you have repaid a loan, right? So but obviously loan of rupees 10 lakhs that you borrowed 10 years back will not be remain same. So that 10 lakh rupees value will be decreased, right? So whenever there is a change in value of your asset and liability, you have to find out whether it's a profit for your business or it's a loss for your business, right? Simple logic is there. So whenever asset value increases, whenever value of asset increases, it's a profit for you, sir, right? Whenever your asset value increases, it's a profit for you, and whenever asset value decreases, it's a loss for you. And it is an exactly opposite for your liability. Whenever liability of your business increases, it's a loss for you, and whenever liability decreases, so it's a profit for you, right? The simple logic is this, and that we have to put into the revaluation account. So as I said, your revaluation account is as good as your profit and loss account. On the debit side, you have to write down losses and expenses, and on the credit side, you have to write down profit and gain. So if value of asset increases, it's a profit for you. So you have to write down on the credit side, value of asset increases, and you have to write down what? You have to write down the margin by which value of asset increased. You have to write down that. If the previous value of asset where you purchased land 5 years back for 50 lakh rupees and now the value is 80 lakh rupees. So you have to write down difference between two, right? That is your profit. That is nothing but in my example 30 lakh rupees. 30 lakh rupees by 30 lakh rupees asset value get increases. So that you have to write down on the credit side of revaluation account, right? Difference you have to write down. So if asset value increases, it's a profit for you. You have to write it down on the credit side. If the value of asset decreases, it's a loss for you. You have to write it down on the debit side. Similarly, if value of asset liability increases, so it's a loss expenses for you. And if your liability decreases, so it's a profit and gain for you. That's simple. So you have to prepare revaluation account based on this concept. At the end, when you close down revaluation account, you will be finding either surplus or that is nothing but revaluation profit or revaluation loss. If you're getting balance here on the debit side, so it's a revaluation profit. And if you are getting balance here, so it is known as revaluation loss. Wherever side you get balance, whether it's a profit or loss, you have to transfer that profit and loss towards all the partners including the retiring partner, right? You have to transfer that towards their capital account or current account, whatever method you are following for maintenance of capital account, right? So whether it's a revaluation profit or revaluation loss, you have to transfer towards partners capital and current account. Among all the partners, you have to distribute as per their old profit sharing ratio, right? Sadhana, Parsati, understood this concept? Dhanishri. The
sir,
same concept.
I have a doubt in this concept, sir. I came across a sum, sir, in which it says that bank overdraft of 20,000 is fully paid. As it is a decrease in liability, can you write it in credit side, sir?
Absolutely right. If bank overdraft you paid off, then your liability decreases. There is no loan available, right? You have paid all the loan. So the entire balance which is paid off, so that is your gain, that is your profit. You have to write down on the revaluation account credit check. Yes.
Okay, sir.
Yes. Any doubts apart from these 21 sadhana parts are? Okay. Now which entries we have to pass? See, entries are normal, you are aware about the entries, right? See, I am preparing once again that format of revaluation account. Revaluation account. On the debit side, you have to write down losses and expenses, and on the credit side, we have to write down income and or profit. Okay. See now, for increase in value of asset. So if value of asset increases, where I'm going to write it down? Tell me. If value of asset increases, where I need to write it down in revaluation account? Debit side or credit side? Absolutely right, credit side. So I will be writing here now by the respective asset. For example, value of machinery increases. So I will be writing down here by machinery account. Now I need to develop journal entry. Sir, you have write it down on the credit side of revaluation account. It means you have created revaluation account. Yes or no? And so what is meaning of buy? So buy means debit. So you have to debit what? You have to debit a machinery account. Simple. So your journal entry will be asset account debit to revaluation account. Simple. You have write it down on the credit side. So revaluation account you have to credit and you have to debit that asset account. Then for decrease in value of asset. So whenever value decreases, you are going to write down where? So you'll be going to write it down on the debit side. For example, to furniture account. You will be writing here furniture account. Right? So here if you see, you have debited revaluation account. Yes or no? You have recorded on the debit side of revaluation account. So what will be the entry? The entry will be revaluation account debit to that asset account. If the asset name is furniture, so I will be creating furniture account. So this 2 is nothing but credit. Simple. Then for increase in amount of liability. So if your liability increases, so it's a loss for you. You will be writing it down on the debit side, the liability name. For example, the name of the liability is creditors. Amount. Liability increases, it's a loss for the business. I have recorded on the debit side of revaluation account. So which account I have debited? Sir, I have recorded on the debit side of revaluation account. So my journal entry will be revaluation account debit to that liability name. In my case, it's a creditors. So to creditors, so 2 is nothing but credit to creditors account. Simple. Then, so if liability decreases, then so if a liability decreases, I will be writing on the credit side. For example, you paid off bank overdraft. So I will be writing here by bank overdraft. You have paid off your bank overdraft. So your liability decreases. It's a profit for you. You have written on the credit side of revaluation account. Right? So revaluation account get credited. Which entry we have to pass? So buy means debit. So you have to debit what? You have to debit bank overdraft account. So bank overdraft account debit to revaluation account, right? This entry we have to pass. Then, so after that, for an unrecorded asset. So what is the meaning of unrecorded asset? For example, last year you purchased some stock of some raw material, right? For example, my business is manufacturing of this pen, and for this I have purchased 10,000 rupees of plastic, raw material plastic, and we haven't recorded that at that time, right? And when we go into the go down, we able to see, so there is 10,000 rupees of stock available there. So previously you haven't recorded that asset, right? Stock is asset. Now you realize that we haven't recorded that. So what you have to do? You have to record now. So if you are recording it now, what will happen? So your asset will get increases now. If you are recording unrecorded asset today, what will happen? Your overall asset balance will get increases. Your stock balance will get increases. So you'll be writing it down on the credit side by stock account, right? So if value of any asset increases, it's a profit for me. So I will be passing journal entry same. Revaluation account here created. So we have to debit what? We have to debit that unrecorded asset account. That is stock in my example. Stock account debit to revaluation account, or any asset account debit to revaluation account. See here. For an unrecorded asset, entry will be, you have to debit the revaluation account, right? Any doubt, any confusion in these journal entries? So the journal entries are based on your revaluation account. Simple debit credit you have to see, and you have to develop a journal entry, right? Sadhana, Parsarthi, Dhanushri, any doubt in this? Okay, Dhanushri. Okay, Parsarthi. Yes, Sadhana, any doubt? Okay, so I'm moving further. See now. It is a liability. So what is unrecorded liability basically? First of all, I'm preparing that revaluation account here. So what is meaning of unrecorded liability? So for example, I can say, same case, so I bought 10,000 rupees of material on a credit basis from Parsarthi, right? So it means I'm supposed to pay him 10,000 rupees, but this transaction I haven't recorded in the books of accounts. But today I have realized that, sir, I have not recorded this purchase of 10,000 rupees of material from Parsarthi in the books of accounts. So it means I supposed to pay 10,000 rupees to Parsarthi. So if I supposed to pay 10,000 rupees to Parsarthi, my overall liability will get increases, right? And whenever your liability increases, it's a loss for you, right? And that loss we have to pay, right? Liability increases, right? So I will be writing down to creditors account. So Parsarthi is my creditor. I am writing on the debit side to creditor account. I need to pay to the Parsarthi. So what will be the entry? So you have debited what? You have debited revaluation account. Revaluation account debit. So whenever there is an unrecorded liability, you are recording today, you have to simply pass journal entry. That liability account you have to, that particular liability you have to credit, and revaluation account you have to debit. So revaluation account, this entry you have to pass. Okay. So after doing all these things, what you have to do? Simply you have to close down this revaluation account. You have to check the total of debit as well as total of the credit side. If the total of credit side is more as compared to total of the debit side, you will be getting balance here, and is known as revaluation profit. And this revaluation profit you have to distribute between all partners. Between all partners capital account you have to distribute, right? Revaluation profit. If you see here, you are getting balance where? Profit you are getting where? So you are getting profit balance on the debit side. You are getting it on the debit side. So it means revaluation account you have debited, right? So whenever there is a revaluation profit, what will be the journal entry? So journal entry will be revaluation account debited to all partners capital accounts. So 2 is always credit to all partners capital or current account, whatever method they are following, and we have to distribute this in the old profit sharing ratio. See journal entry, revaluation account debit to all partners capital account, right? Now, so if your debit side is more and your credit side is lesser, in that case you will be getting balance here. If you are getting balance on the credit side, it's known as revaluation loss, right? So even if it is a loss, you have to transfer this towards all partners capital account. All partners capital account, and this is balancing figure, sir, right? This is a balance that you are getting. If you see here, for this balance, revaluation account you have created because you find this balance on the credit side, right? And so buy means debit. You have to debit what? You have to debit all partners capital account, individual name. For example, partner A capital account, A's capital account debit, B's capital account debit, C's capital account debit to revaluation account, right? I can say it's an exactly opposite of your revaluation profit. See the all partners capital account debit to revaluation account. You have to distribute the same between all the partners as per their old profit sharing ratio. Understood this journal entry? Partharthi, Sadhana, Dhanushri. Any doubt in this? Okay, Partharthi. Okay, Sadhana. Okay, Dhanushri. Okay, I'm moving further now. Now, so after that concept, so next another important concept is distribution of accumulated profit, reserves and losses. So this concept, same concept we did in the chapter of admission of a partner. Only slight differences there, and that I will be going to discuss here. Sir, what is accumulated profit, reserves and losses? So it is simple. For example, I started a business in the year 2010. We started business in the year 2010. When we started a business, so there were two partners, partner A and partner B, right? And today in the year 2023, we decided to give a admission to partner C into the partnership from business. So from 2010 up to 2023, so whatever business we have done is only because of the efforts put in by only partner A and B, right? Because C is not in the picture so far, right? He came into the business in 2023. So I can say whatever profits and losses are enjoyed by the business or loss suffered by the business over a period of 2010 to 2023 is always belongs to partner A and B, right? And we know, sir, every year whatever profit you have earned, you are not going to distribute that entire profit among yourself. You will be having some portion as a reserve, because you are not doing business for 1 year. No, you are doing for business for longer period of time, and for that you require money as a reserve, right? So over a period of time, when there is a profit you have kept aside over a period of time, so it is known as accumulated profit, right? The total profit that you have kept aside, or it is known as reserves, right? And there is possibility of some losses are also there, right? Over a period of time, for example, from 2010 to 2023, you might be suffered losses also in some years. So that losses you have to adjust with your profit, right? But those losses I cannot directly adjust with any year profit. I will be systematically, I will be going to adjust that over a period of time, now, over a period of 5 years or 10 years, because that loss will be huge. So it is not possible for me to write off that loss in one single year. For example, in 2010, when I started a business, I enjoyed a profit of rupees 50,000. Now in 2011, I suffered a loss of rupees 60,000. In 2012, so there is again a profit of rupees 40,000, right? So I cannot adjust this 60,000 rupees of loss with this 40,000 rupees of profit. So what I need to do? So I systematically, that 60,000 rupees of loss, I need to systematically segregate over a period of time. I will be going to adjust that over a period of time, right? So far, if I'm not going to adjust that loss, right, ultimately, or total loss, I'm not going to adjust with the profit. So that is known as accumulated losses, right? So whether it's accumulated loss, whether it's accumulated profits, whether it's a reserves, so everything belongs to whom? So everything belongs to partner A and B only, because they are doing this business from 2010 up to 2023. C partner joined the business in 2023. So the ideally, logically, whatever accumulated profit, reserves and losses are there on the occasion of admission of this partner C belongs to A and B only, and we have to distribute between A and B only as per their older profit sharing ratio, right? This concept we studied in admission of a partner. Now what happening is here, sir, in the retirement of a chapter or retirement of a partner concept, I can say there are three partners, A, B and C. They are running this business from 2010, and today in 2023, C partner is going out of the business. He is retiring from the partnership from business, right? Now tell me, whatever accumulated profit, losses and reserves are there from 2010 to 2023, who are responsible for that? Which efforts are put in? Who put in efforts so far? So, but obviously, efforts are put in by A, B and C, all the three partners jointly, right? So if partner C is going out of the business today, so we have to pay back him his portion of I can say accumulated profit, reserves and losses, right? So in case of retirement of a partner, so logic is same. Only thing is we have to distribute accumulated profit, reserves and losses among all the partners, including partner C, that is retiring partner, because he was there in the business now. But in case of admission of a partner, C partner joined the business in 2023. Now how he will get the accumulated profit before that? No, so it's not possible. But in case of retirement of a partner, C partner was there in the business, no sir, from 2010 to 2023, right? So that C partner will get the accumulated profit share, right? So in case of retirement of a partner, so on the occasion of retirement of a partner C, we have to distribute all the accumulated profit, reserves and losses between all the partners as per their old profit sharing ratio. So as per their old profit sharing ratio. So what are the different types of accumulated profit, reserves and losses? So we are aware about, if you are getting balance of profit and loss account, if you get profit and loss account balance on the liability side of balance sheet, then it's a profit, sir. Right? And it is also known as profit and loss account. Which balance, sir? Credit balance. Right? If you get profit and loss account balance on the balance sheet asset side, sir, right, it is known as loss, right? And it is a profit and loss account debit balance. It is known as debit balance, right? So this is a loss, this is profit. Then what about reserves, sir? So there are different types of reserves, and reserves always you will find on balance sheet liability side, sir. Reserves always you will be finding on balance sheet liability side. It's a part of profit always, sir. It's a part of profit always, right? So what kind of reserves are there? So reserves can be like of your general reserve. General reserve will be there. Then your investment fluctuation reserve will be there. Investment fluctuation reserve will be there. Then your workman compensation reserve is there. Workman compensation reserve will be there, right? This kind of reserves will be there on the balance sheet liability side, you will be finding, right? So this we have to distribute among the partners, right? In case of retirement of a partner, we have to distribute the same among all the partners, right? As per their old profit sharing ratio. Now the question is, so to record that in partners calculate current account, which to record debit or credit side, and which entry we have to pass. See, it is simple, very much simple. It's very much simple. Sir, suppose balance sheet is given to you. As I said, you will be finding, if you are, it is a liability side and this is asset side. So if you're finding profit and loss account balance here, profit and loss account balance, then general reserve is here. So we know this profit and loss account balance is nothing but profit for you, right? General reserve is also part of profit. So you have to transfer all these profits to all the partners and their capital account, right? Or current account, whatever method they are following, and you have to distribute between all the partners, including retiring partner, as per their old profit sharing ratio. Now, sir, which entry we have to pass? So entry is simple and normal. So we know profits we always distributed, or profit is always be recorded on the credit side. So if these are the profits, we have to record it on the credit side of partners capital or current account, right? So that is sure, we have to record it down on the credit side of partners capital or current account. Then which account to debit, sir? So I will be debiting that respective profit and loss account. So if I am transferring profit and loss account balance, I will be debiting profit and loss account debit, general reserve account debit to all partners capital or current account in their old profit sharing. Simple. So it is a profit we have to record on the credit side always, right? So we have to write it down on the credit side of partners capital or current account. See the journal entry. So profit and loss appropriation account. So that is nothing but your profit and loss account balance, right? General reserve will be there, reserve fund will be there, workman compensation fund will be there, investment fluctuation fund will be there, right? All these reserves and profits we have to debit, and we have to create what? We have to create all partners capital and current account in their old profit sharing ratio. Now, sir, if you find balance here on the asset side. Which balance, sir? Profit and loss account balance. If you find profit and loss account balance here, so it is a loss. And so we know losses we have to record on the debit side of partner's capital and current account. So in that scenario, what will be the entry? So entry will be all partner's capital current account debit to profit and loss account balance in their old profit sharing ratio. Simple. So profits you are going to record on the credit side of partner's capital account, and loss you are going to record on the debit side of partner's capital accounts. And accordingly you have to develop general entry, right? And you have to distribute the same in the old profit sharing ratio. Understood? Parthsarathi, Sadhana, Dhanushri. If you have any doubt, questions, you can ask me. Okay, Dhanushri. Yes, Sadhana. Yes, Parthsarathi. Understood? Okay, Sadhana. Yes, Parthsarathi, understood? Any doubt? Okay, so I'm moving further now. We'll see question. See the question. Amit, Suraj and Jay. So there are three partners. Amit, Suraj and Jay. Are partners sharing the profits and losses in the ratio of 3:2:1. On 31st of March 2017, Suraj retired. On the date of retirement, the books of the firm showed a general reserve of rupees 6,000. So there is a general reserve of rupees 6,000. So general reserve is nothing but your profit, right? Pass the general entry to transfer the general reserve. You have to give an entry for transferring the general reserve, right? I'm giving you 2 to 3 minutes. Just let me know the answer. Pass, roughly you can solve and you can tell me the answer, right? Once you're done, let me know you have finished or not, right? Yes, Sadhana, Parthsarathi. Yes, Dhanushri. Completed. Tell me the answer.
General reserve account data to Amit's capital account, Suraj's capital account, Jay's capital account.
General reserve account debit to
6,000.
Amit capital, to Suraj capital, and to
Jay.
Jay's capital. Absolutely correct. The total balance is 6,000 rupees. We have distributed in the ratio of 3:2:1. So answer will be 3,000, 2,000, 1,000. Right? Let's start now. Yes. Yes, Parthsarathi. Okay, good. Now, see this one. Give me entry. Mamta, Sehaj and Manisha are partners. Mamta, Sehaj and Manisha are partners of the firm, sharing the profits and losses in the ratio of equally. So 1:1. Mamta retired from the partnership on 1st of January 2019. On the date of their balance sheet showed accumulated loss of rupees 7,500. So accumulated loss of 7,500 is there on the asset side of the balance sheet. Give general entry to distribute the accumulated loss. Tell me general entry for distribution of the losses.
Mamta's capital account debit.
Mamta's capital account debit, right?
Sehaj's
capital account debit, right?
Manisha's capital account.
Manisha's capital account debit to
profit and loss.
Profit and loss account balance. So amount is 7,500. We have to distribute the same between all the three partners as per their ratio equally, right? Yes, Parthsarathi, right? Yes, and the ratio is 2,500 rupees each. Yes, simple. Okay. Next. See this question now. The question is given to me, right? Balance sheet is available in the question. What they are saying, Rahul, Datta and Sanjay are partners. Rahul, Datta and Sanjay are partners in the firm. They are sharing the profits and losses in the ratio of 2:4:1. Their balance sheet as on 31st of March 2019 as follows. So whenever you are solving, for example, you are solving 6-mark question and they are asking you to prepare revaluation account or partners capital account, what will be should be your approach, right? So first of all, by looking into this balance sheet, what you have to do now, you have to first of all check out their capital balances. So capital balance are Rahul, Datta and Sanjay. Simply you have to write it down on the partner's capital account credit side by balance brought down. There is no journal entry for recording of balances, right? You have to write it down on the credit side of partner's capital account like this by balance brought down. Simple. Okay. After that, you have to find out whether there are profits reserves or not, right? If I see here, I will be getting here profit and loss appropriation account balance. It's a profit. General reserve balance is there, 15,000 rupees. Workmen compensation fund is there, 17,000. So I find, sir, there are 3 profits, 10,000, 15,000 and 17,000. All these 3 profits I need to transfer towards partner's capital account, right? So which entry I need to pass here? If I'm passing journal entry, I will be passing journal entry of what? Tell me. You will be passing journal entry, profit and loss appropriation account debit, right? How much? 10,000 rupees, right? Then general reserve account debit, right? How much? 15,000 rupees, sir. Then workmen compensation fund accounts. How much? 17,000 rupees. Yes, parts are. And you have to transfer this towards all partners' capital account. Rahul capital account, to Datta's capital account, and to Sanjay's capital, no? Sanjay's capital. Right? After passing the journal entry, you will be write it down on the credit side of partners' capital account. Right? By profit and loss appropriation, by general reserve, and by workmen compensation fund. Right? You're saying 12,000 rupees from Rahul. Okay, Ram, Rahul, whatever it is. Datta 24,000. Ram is 12,000 rupees. Datta is 24,000 rupees. And for Sanjay, it's a 6,000 rupees. Just check. 10, 10, 25, 25 plus 17. 42. So 42, 40, yes. No issues, Parthsarthi, Rahul. I have written as a Ram. I'm not written it correctly. That's why. Yes, simple sadhana, Dhanushri, Parthsarthi. Okay. Now this concept is new and this is only related to your retirement. This is only in retirement of a chapter, not in your admission of a partner. And this concept is important. Yes, Dhanushri, am audible?
Yes, sir.
You can have yes, you can have a 5 minutes of break. Parthsarthi, Dhanushri, and Sadhana. Then I will be starting with the new concept, right? And this concept we have not covered in admission of a partner, right? This is altogether new concept. This is only in the retirement of a partnership, right? So we'll discuss this. Take a 5 minutes of break. We'll start after 5 minutes. Yes, Dhanushi. Are you there? Okay. Sadhana and Parth Sarthis are not there. I guess they are having network issue. Is there any rain in your state, in your area, Dhanushi? Okay. Can you turn on your mic? Yes, Dhanushi?
Sir, can you hear me now, sir?
Yes, I can hear you now. Okay. So we are going to see this concept now. Adjustment for current year profit or loss up to date of retirement. So what does it mean actually? See, if my current year is 1st April 2021 up to 31st of March 2022, right? And there are three partners, partner A, partner B and partner C. C is retiring from the partnership from business. He can retire from the partnership from business at any time, right? He can retire at the beginning of the year, right? He can retire at the end of the year, or he can retire at the middle of the year. It's depend upon his choice, right? And accordingly, I need to pass journal entries and I need to do accounting. See, if partner C is retiring at the beginning of the year, then he will not get any amount of profit of the current year, right? We are not supposed to give him any profit during the profit share from the current year, because he retiring at the beginning on 1st of April 2021 is retiring from the partnership from business. So from 1st April 2021 up to 31st of March 2022, he was not there in the business. Yes or no? So I'm not going to give him any profit share. Right?
Yes, sir.
So if partner C is retiring at the end of the year, so that is nothing but on 31st of March 2022. So it's simple that for entire year profit from April 21 to 31st March 2022, for this entire year he was there in the business, right? So I supposed to pay him his share of a profit. And sir, we know on 31st of March 2021 we used to prepare financial statement, right? So I can able to calculate what is the correct and actual profit of the business for this year, right? And I can give him his share at the time of retirement, that is on 31st of March 2022. So in case of beginning retirement, in the case of end of the year retirement, there is no problem, sir. But if he retiring from the business in the middle of the year, right? If he's retiring from the business in the middle of the year, for example, he's retiring on 31st of October 2021, right? So he's retiring from the partnership business in the middle of the year, and that creates a problem, sir. Why? Because, sir, he is not retiring in the beginning, he is not retiring at the end, he is retiring in the middle. So in this scenario, I need to give him his share of a profit for that much of period. So from where? From beginning of the year up to date of his retirement. Yes or no? Because he was there in the business up to 31st of October 2021. So from April 2021 up to October 2021, he was there in the business for this much of months. So it's my job, it's my, I can say, obligation on me as a businessman or as a firm to pay him his share of a profit from April to October. So April, May, June, July, August, September and October. How many months are there? April, May, June, July, August, September and October. Total 7 months.
7 months.
1st of October then 6 months. If 31st of October, 7 months. So I am considering 7 months. 7 months. But sir, we know, Dhanushri, that we are going to prepare financial statement only on 31st of March 2022. Not before that, no? Right? You cannot prepare only because of the retirement of partner C. You cannot prepare balance sheet and profit and loss account on 31st of October 2021. You are going to prepare that only on 31st of March 2022, right? But sir, it is also obligation on part of mine to give his share of a profit to him, right? For 7 months of profit. So then how to calculate that 7 months profit, right? So there are ways to calculate 7 months of profit. So first thing is you can assume it's not an actual profit, right? Because actual profit answer you will be getting when? On 31st of March 2022 only, right? When you prepare your profit and loss account on 31st of March 2022, at that time you will be getting actual profit. But sir, if you are calculating profit on 31st of October 2021, it's not your actual profit, it's an estimated profit, right? You are estimating the profit. What would be the profit of this whole year from April to March, and by considering that 12 months of profit, estimated profit, you will be going to give a share to that retiring partner of the 7 months, right? So for that, there is a way for calculation of estimated profit, and that is nothing but you can consider last year profit as a current year profit. You will be consider what? You will be assuming what? So profit that we earn in the previous year will be same in the current year, right? They will be assuming like this. So the profit that you earn in 1st of April from 1st of April 2020 to 31st March 2021. This is my last year, right? Last year you earned total profit of 60,000 rupees. So what you are assuming here, that same amount of profit I will be going to earn from 1st April 2021 up to 31st of March 2022, right? And based on that, I will be give a share to that retiring partner. So I'm assuming this year profit will be 60,000 multiply by, sir, I need to calculate what? 7 months of profit now. I need to give him 7 months of profit. 60,000 multiply by 7 divided by 12 multiply by C partner's profit sharing ratio. And for example, his profit sharing ratio is equal 1 by 3. So I will be calculating like this 1 by 3. And then I will be getting his profit share. Understood?
Yes, sir. But can't we just give the partner share at the end of the year with interest?
No. You cannot. See, you have to do accounting. You have to do accounting on the occasion of retirement only. Yes or no?
Yes, sir.
If partner is going out of the business on 31st of October, then you have to tell him now how much amount of profit you are going to pay him. And for that you have to do recording, you have to do accounting. See, it's not a final thing. When you on 31st of March, when you finalize the books of accounts, you will be able to find out what is actual profit, right? At that time, you will be going to adjust that, right? For example, 7 months profit you have calculated. Solution will be. Can you tell me what is the answer here? 60,000 multiplied by 7 divided by 12 into 1 by 3. I guess it's in decimal.
$11,666.66.
Oh, I am considering 11,666. Okay, so this is the profit. This is not final profit, right? That's why we are not considering profit and loss account. We are considering profit and loss suspense account. Profit and loss suspense. So what is meaning of suspense? So suspense indicates that this is not your actual profit. This is your estimated profit. And when you, on 31st of March, you will be finalizing books of accounts now. At that time, you will be getting correct profit, and with that correct profit, you have to adjust this estimated profit. And that is not in our syllabus, how to adjust that profit. So we have to simply calculate on the date of retirement of that partner on 31st of October 2021, we have to calculate his share of a profit from the beginning of the year up to his date of retirement. That's it, right? And the basis on which we have to calculate profit will be provided to you in the question. If they are saying you have to consider last year profit as a base profit for calculation of share of the retiring partner, I will be doing that. Understood now?
Yes, sir. Understood.
Yes. Now sometimes this is the first way to calculate that retiring partner share. Now sometimes what will happen, will give you in the question profits of last 4 years. Profit of last 4 years, and they will be asking you to calculate average profit of 4 years and whatever average profit you will be getting now, that should be base. That should be base for calculation of that retiring partner share, right? In that case, simply, yes, in that case, simply what you have to do, you have to add each and every year profit which is available, divide by 4, right? Because it's 4 years profit. You will be getting average profit. So that average profit is for 12 months, right? You will be getting, for example, you are getting average profit 80,000 rupees. So just for 12 months, you are not going to give him 12 months of share now. You will be going to give him only from date of beginning to the date of retirement. For example, here
into 7 by 12 yes, into 1 by 3.
Absolutely right. 7 by 12 into 1 by 3. So there are two options available in the question, or two scenarios will be there. Either they will ask you to consider last year profit as base profit for calculation of his share in the his retiring partner share for the current year, or they will ask you in the question you have to calculate average profit of last 4 or 5 years, and that average profit will be based for calculation of share of the retiring partner. That's it, right? And for that, whenever you are passing the journal entry now, you have to use word suspense account in your profit. Because it's a temporary account, it's not permanent, it's not an actual profit. And that's why it indicates that, the word indicates that it's not an actual profit. So entry will be profit and loss suspense account debit to retiring partner's capital or current account. Simple?
Yes, sir.
Yes, Anushri? Sadhana? Okay. Now, we'll see the questions. So we'll get more clarity, right? Ajay, Akash and Rakesh are a partner sharing the profits and losses equally. On 31st of March 2029, financial year ends on 31st of December every year. There's small mistake in writing this question. Their financial year end on 31st of December every year, that is correct. So their year started on January and it will end on 31st of December every year. Okay. Rakesh retired from the partnership firm on 31st of March 2019. They are saying here. On 31st of March 2019, he retired from the partnership firm business. Who? Rakesh. And profits of the preceding years are as follows. So profit of 2016, 17 and 18 is available to me, right? So if I say here, my year is January to December, and if partner is retiring on March, right, 31st March, it means he was there in the business from January to March. For how many months? 3 months. He was there in the business for 3 months. So I'm supposed to pay him 3 months of profit, right? So find out share of a profit of Rakesh for the year 2019 till the date of his retirement. Now 2 questions are there. Profit is to be distributed on the basis of previous year profit. So previous year is nothing but last year. So what is last year? So last year is 2018. So last year profit is 30,000 rupees. So I will be considering like this. 30,000 is my last year profit, right? Multiply by
3 by 12.
3 by 12. I need to pay him 3 months of profit. Multiply by Rakesh share. Rakesh is the retiring partner, na? So what is Rakesh share here?
1 by 3.
1 by 3 equals into 1 by 3. So what will be my answer? 2,500. Right? Am I correct?
Yes, sir. Yes, sir. 2,500.
Okay. 2,500 rupees will be the 2,500 will be the profit to the Rakesh. So which entry I need to pass? The entry will be profit and loss suspense account debit to Rakesh capital or current account. Whatever method they are following, 2,500, 2,500, simple. Now, this is they are saying profit is to be distributed on the basis of average profit of past 3 years. So in this scenario, I need to calculate what? I need to calculate first of all average profit of last 3 years. So average profit will be how much? So 2016 profit is 5,000. 10,000 plus 30,000, right? Divided by 3.
Yes, sir.
Right? So 45,000 rupees divided by 3, it comes to 15,000, right? So 15,000 is the average profit, multiply by, so we have to give him only 3 months of profit, right? 3 divided by 12, multiply by 1 divided by 3. So what will be the answer?
1,250.
1,250 will be the amount of profit. So entry will remain same. Profit and loss suspense account debit to Rakesh capital account. Right, Sadhana? Any doubt, Dhanishri?
No doubt, sir.
Understood this concept?
Yes, sir.
Yes, Sadhana? Okay, Dhanishri? Okay. Now, so after these, we have to see now goodwill adjustment. See, this goodwill adjustment now, in your CBSE syllabus, there is only one journal entry for goodwill adjustment that I'm writing down here. So that is nothing but whenever there is a goodwill adjustment, you have to check who is a gaining partner. Whether it's in case of admission of partner, retirement of a partner, you have to check who is the gaining partner and who is a sacrificing partner. That's it. After finding who is a gaining partner and who is a sacrificing partner, now you have to simply debit gaining partner's capital or current account. Gaining partner capital or current account you have to debit, and you have to credit sacrificing partner capital or current account. That's it, right? Gaining partner's capital account you have to debit, and sacrificing partner's capital account you have to credit. Why, sir? Says the concept is simple, sir. The sacrificing partner, we have to give a share. We have to give a benefit now to the sacrificing partner because he's losing, right? He is giving away his share to someone. Then we have to sacrifice partner's capital account. We have to credit. We have to increase his capital balance, right? If the retiring partner is there, if partner C is going out of the business, then it's a responsibility on the part of firm to pay him his goodwill share. So whatever name, fame, reputation of the business is today is also because of the efforts done by partner C. So we have to give him his share. So that's why whenever there is a retiring partner or whenever there is any sacrificing partner, we have to debit that sacrificing partner, right? Because we have to compensate for his sacrifice. And sir, in case of retirement, the one partner is going out of the business and two partners are there and both will be the gaining partners, for example, right? So if because of the retirement of a partner C, his share is now going to be enjoyed by that remaining two partners, then for future benefits that they're going to get future benefits because of the retirement of a partner C, sir, now they have to sacrifice, they have to adjust for goodwill amount towards that retiring partner, and that's why we have to debit their partner's capital account. So when you debit any partner's capital account, their capital balance will get reduced, and whenever you credit any partner's capital account, their capital balance will get increased, right? So in case of admission of a partner, in case of retirement of a partner, you have to simply remember this logic. Even in case of chapter of change in profit sharing ratio, right? So there is a concept of goodwill adjustment also, is there also, right? Even in that scenario also, you have to pass same entry, gaining partner's capital account debit to sacrificing partner's capital account. Only important thing is you have to calculate what? You have to calculate correctly gaining partner and sacrificing partner ratio. Gain ratio and sacrifice ratio you have to calculate correctly. Then only you will be able to solve correctly the general entry, right? So that is the case of your CBSE syllabus. But in case of CA foundation, sir, there is more detailing, right? So whatever I will be going to discuss here, it's more of your CA foundation, right? And less of your CBSE, because in CBSE only this one general entry is sufficient, right? They will ask you, they will judge your knowledge of this only, gaining partner's capital account and sacrificing partner's credit account, sacrificing partner's account we have to credit. And they are going to judge you whether you are able to calculate gaining partner ratio and sacrificing ratio. That's it. right? Understood, Dhanashri Sadhana? Okay. See, there are cases, different cases. Case number one, I'm discussing this from CA Foundation point of view. When goodwill does not appear in the books, then there are two options: raising the goodwill to its full value and retaining in the books, raising the goodwill to its full value and writing off immediately. There are two cases available when goodwill is already given in the balance sheet on the occasion of retirement of a partner. You can raise goodwill, or you can raise the goodwill and return off. Raise the goodwill and retain in the business. So raising a goodwill and retaining in the business means goodwill will appear in the balance sheet after retirement of a partner. Raising goodwill and then return off immediately, it means goodwill will not appear in the balance sheet, right? I'm just giving you theoretical thing. I'm not reading everything. We'll show you question and solution. Then you will get more clarity. Then, so after that, see, third thing, raising goodwill to the extent of retired deceased partner share and writing off immediately. You are raising goodwill now, but not of the entire partnership from business goodwill. You are raising goodwill to the extent of what? To the extent of retiring partner share. So for example, retiring partner share is 1/3. So you'll be raising goodwill for 1/3 share, and then you are going to write it off. Write off means goodwill will not appear. You are distributing that goodwill among the, you are going to adjust that goodwill between the partner's capital only. Gaining partner, by finding out who is the gaining partner and who is the sacrificing partner. Then by not raising goodwill account at all in the firm's book. So not raising goodwill means, not raising goodwill is simple meaning is whatever goodwill available in the balance sheet, you have to simply distribute that goodwill among gaining partner and sacrificing partner. That's it, right? So these are the scenarios available. Now, see, you will get clarity by seeing this question only. Just keep that theoretical part aside. See this question. And this is from your CA Foundation. XYZ are partners in the firm, sharing the profits and losses in the ratio of, I'm writing down for your further information. Whenever you see this session or you'll refer this PDF, you will be understand. So this is from CA Foundation and not related to your CBS. Okay, see question now. XYZ are partners in the firm, sharing the profits and losses in the ratio of 3:2:1. X, Y, and Z are three partners. They are sharing the profits in the ratio of 3:2:1. Y retired. So Y retired from the partnership from business. Okay. The value of goodwill of the firm is 1,20,000 rupees. So at the time of retirement of a partner Y, goodwill is already there in the balance sheet, and value of goodwill of firm at the time of retirement is value of goodwill of a firm at the time of retirement is 1,20,000 rupees. In the ratio of 3:1, the remaining partner X and Z continue to share the profit. So in the ratio of 3:1, the remaining partners X and Z are continue to run the partnership from business. So this was the older profit sharing ratio available. Now they are saying, what is the new profit sharing ratio? Sir, who will going to continue? So X and Z is going to continue this business between themselves in the profit sharing ratio of 3:1. Okay, sir. Pass journal entries under the various alternatives. So I will pass journal entry, but first of all, I am interested here in calculation of who is the gaining partner and who is the sacrificing partner. That one thing I will be doing first, right? So for that, see, I am writing down here. I know what is gaining ratio formula. Tell me what is gain ratio formula. So gain ratio formula is new share minus old share. Yes or no? Yes or no, everyone? Dhanushri, Sadhana, tell me. Gain ratio formula is new share minus old share. So by solving this, if I'm getting answer positive, it's my gaining ratio. If I'm getting answer negative, it's sacrificing. Simple, right? By solving this, if I'm getting answer positive, so it is a gain. And if I get answer negative, so it's a sacrifice. That partner is sacrificing, right? That I know. Okay, so I will be seeing once again what is their profit sharing ratio. Okay. See, 3:2:1 is their old profit sharing ratio. 3:2:1. And their new profit sharing ratio is 3:1. 3:2:1 and 3:1. So 3:1. Old profit were 3:2:1, right? 3:2. I'm not aware about their names. Means I forget their names. Please remember their names. XYZ, right? XYZ 3:2:1, and then X and Z 3:1. Please remember this. 3:2:1. X, Y, and Z. So what was their old share? 3:2:1 means 3 2 plus 2 5 plus 1 6, right? So 3/6, 2/6, and 1/6. And what is the new profit sharing ratio? 3:1. So 3/4 and 1/4. 3/4, and for Z it's 1/4. And what about Z? It's 0. He is not no longer the partner of the business. So we have to subtract this. We'll be getting the answer. See what is the answer? Yes, after simplification, this is what will be the answer. You can do it by LCM or cross multiplication. 6 3s are 18 minus 4 3s are 12, right? Divide by 24. So what is the answer here? 6/24 positive. So it means he is a gaining partner. Then, so 0 minus 2/6, the answer will be 2/6. 2/6. So 2/6 negative means this is the sacrificing partner. This is the gaining partner. Then, so I need to simplify this. 6 1s are 6 minus 4 1s are 4 divided by 24. So answer will be 2/24. So this 2/24 is also positive. So he is also gaining partner. So partner Z and partner X are gaining partner. These are the gaining partners. And partner Y is the sacrificing partner, right? 2/6 is the share. So after finding this, I can able to solve the journal entries, whatever they are asking me. Okay, see now. See, raising the goodwill to its a full value and returning in the books. What they are saying, so they are saying you have to raise the goodwill to its a full value and you have to return the in the business. So whenever they ask you to raise goodwill, it's a full value. You have to simply do what? You have to simply distribute goodwill of rupees 1,20,000, which is available in the question, among all the partners as per their old profit sharing ratio. That's it. That is known as raising of goodwill, right? So whenever they ask you to raise a goodwill, you have to simply distribute goodwill amount rupees 1,20,000 rupees among all the partners. See, in the goodwill account debit to X capital, Y capital, Z capital as per their old profit sharing ratio. There is no use of sacrifice and gain at all, right? So goodwill raised at full value, credited to all partners in their old profit sharing ratio. That's it, right? Okay. Then raising the goodwill at full value and writing off immediately. When they ask you to do this now, you have to raise goodwill at its full value and then to have to write it off immediately. Then what? So first entry will remain same. Goodwill account debit to X partners capital, like a Y partner capital and Z capital account you have to credit. When they are saying you to return off it immediately, what you have to do? See now. You have raised goodwill, then you have to write it off goodwill. So whenever you are writing off goodwill, you have to understand, you have to debit what? You have to debit only gaining partners capital account, right? Gaining partner or remaining partner, you can say, in their new profit sharing ratio. So you raise goodwill in the old profit sharing ratio between all partners, and you are going to write it off between in new profit sharing ratio, new PSR in between continuing partners. So in our example, who are the continuing partner? X and Z. See here. X and Z, and in which ratio? So new ratio. So new ratio is 3:1, and old ratio where 3:2:1, right? So goodwill raised and goodwill written off. That's it. Now, so next is raising the goodwill to the extent of retiring partner's share and writing off immediately. You are raising goodwill now, but not entire goodwill, only the retiring partner's share. So in our example, what is retiring partner share? 3:2:1 means 2/6. His share is 2/6, right? And what is the goodwill of the firm. So you have to calculate 2/6, that is share of retiring partner. What it will be? 1,20,000 rupees multiplied by 2 divided by 6. So answer will be 40,000 rupees. So you have to raise 40,000 rupees of goodwill only, right? So whenever you are raising goodwill by rupees 40,000, what you will be going to do? Will be so you are raising only 40,000 rupees of retiring partner. So you have to credit only retiring partner's capital account. See here entry. Goodwill account debit to Y's capital account. You have raised goodwill only of retiring partner. So you have to debit goodwill account and you have to credit Y's capital account for rupees 40,000. Right? Now they are saying you have to write it off immediately. So whenever there is written off, you have to understand whoever the continuing partners, to them you have to debit it. Right? As per which ratio, sir, now? So now not in their new profit sharing ratio, but their gain ratio, right? So gain ratio we have already calculated. What was that? So gain is 6/24 and 2/24. That is 3:1 only. Yes, Sadhana, absolutely correct. You have to see the numerator. If you see the numerator 6 and 2, yes, 3:1 is the answer, right, Dhanushri? So you have to write it off between this partner X and Y, X and Z in the ratio of 3:1. Yes, Dhanushri, understood or not?
Yes, sir, understood, sir.
Okay. Now, so next is by not raising goodwill account at all in the firm's book. So you are not raising goodwill at all. In that case, what you have to do? In that case, the concept, and this concept is important from CBSE point of view. Whenever they are not raising goodwill at all, then you have to simply see who is the gaining partner, who is the sacrificing partner. You have to debit gaining partner's capital account and you have to credit sacrificing partner's capital account. That's it, right? So here, what is the answer? So total goodwill amount is how much? 1,20,000 rupees, right? And you have calculated who is the gaining partner and who is the sacrificing partner, and you have calculated their ratio as well, share as well, right? So you can do it. See the ratio. Six by 24, 2/6, and 2/24. So if you see here, so gaining partner share is 6/24 and 2/24, and sacrificing partner share is 2/6. You have to just apply it on 1,20,000. So 1,20,000 rupees multiplied by 6/24. You will be getting how much? You will be getting here 30,000 rupees, right? You can solve this. Then for partners, this is for partner X, I have calculated. For partner Z, 1,20,000 rupees multiplied by 2/24. How much? 10,000 rupees. And for partner Y, 1,20,000 rupees multiplied by 2 divided by 6. It comes to 40,000 rupees. That's it, right? So what is the journal entry? So journal entry is simple. We have to debit gaining partner's capital account. So gaining partner is X capital account, Z's capital account. We have to debit for 30 and 10, and we have to credit retiring partner's share for rupees 40,000. Understood now? Sadhana, Dhanushri, and this journal entry, without raising of goodwill, we have to adjust goodwill, to partner's capital account. This is important from your CBSE point of view, and rest of the things are important from CA point of view. I hope you understood Dhanush and Sadhana. Okay, good. Now, so we have to see now. It is again from CA Foundation only. Huh? CA Foundation. 7, goodwill already appearing in the books. So what does it mean, and which entries we have to pass and how to adjust? See here. With the help of example, you can understand better. Rajan, Arvind and Ajay are a partner sharing the profits in the ratio of 5:3:2. Goodwill appear in the books at a value of rupees 50,000. Rajan retire, and on the day of Rajan's retirement, the value of goodwill is 30,000 rupees. Sir, in the balance sheet, goodwill is already given to you. How much? 30,000 rupees. Whatever we done previously, in that case, goodwill was not given in the question. You are raising goodwill means you have calculated goodwill, right, of the firm. It means goodwill is given in the adjustment. Now goodwill is given in the balance sheet as well as in adjustment. That is the difference between that question and this question or this concept. In the previous concept, goodwill was not in the balance sheet, but it is given in the adjustment. Now goodwill is given in the balance sheet as well as in the adjustment, right? So in the adjustment, so goodwill is Rajan retired on the day of Rajan's retirement. The value of goodwill is how much? So the value of goodwill is 30,000 rupees, and goodwill in the firm was 50,000. See, once again, I'm reading. Goodwill of the firm appears in the books at value of rupees 50,000 rupees, and when they calculate goodwill at the time of retirement of a Rajan, it comes to 30,000 rupees. This is given in the question. So what to do? So here we have to see the difference between the goodwill amount. How much is the difference between goodwill amount? The difference of goodwill is how much? 20,000 rupees. And this 20,000 rupees of goodwill we have to now adjust among the partner's capital account. See, goodwill account 20,000 rupees, right? To Rajan's capital, Arvind's capital, Ajay's capital 10,000, 6,000, 4,000. And we done this as per their old profit sharing ratio. Goodwill is already appeared in the balance sheet, 50,000 rupees given, and in the adjustment they are saying goodwill is 30,000 rupees. So it means 20,000 rupees of goodwill we have to credit towards partner's capital account, and we have to debit goodwill rupees 20,000. Understood? So increase in the value of goodwill credited to the all partners capital account in their old profit sharing ratio. Yes. So goodwill appear in the books at a value of rupees 50,000. Raja retired, and on the date of Raja's retirement, the value of goodwill is only 30,000 rupees. I have written wrongly, sorry. The value of goodwill actually given in the balance sheet is only 30,000 rupees. And as per the adjustment, they are saying value of today goodwill is 50,000 rupees. It means you have to increase your goodwill amount by rupees 20,000. And whenever you increase goodwill, you have to debit goodwill account and you have to credit partners capital account, because they are the gaining partners, right? All are the sacrificing partners, not gaining partners. Sorry. So what you have to do is simply you have to see here value of goodwill increase or not. Yes, so value of goodwill increase by rupees 20,000. So you have to debit goodwill account and you have to credit all partners capital account as per their old profit sharing ratio. Simple. And so other way around. For example, if value of goodwill as per the balance sheet is 50,000 rupees, right? And as per the adjustment, value of goodwill is 30,000 rupees. Then goodwill value get decreased here by 20,000 rupees. Right? So in that scenario, you have to pass exactly reverse entry. In the case goodwill account is created with the difference between book value and current value, the book value is greater than the current value, right? In the case the goodwill account is created with the difference between book value and current value, and all partners capital accounts are debited in the old profit sharing ratio. So in my example, what I say, so as per the balance sheet, goodwill is how much? 50,000 rupees, and as per the adjustment, goodwill is now how much? 20,000 rupees. In my example, goodwill decrease here by rupees 30,000, In that case, you have to pass exactly reverse entry. Partner's capital account you have to debit, partner's capital account you have to debit, and goodwill account you have to credit for difference of 30,000. Understood? Which ratio, sir? Old profit sharing ratio only. Dhanushri, Sadhana, understood this or not? Okay, okay. See, Rajan, Arvind, Ajay are partners sharing the profits and losses in the ratio of 5:3:2. Goodwill appears in the books at value of rupees 70,000. Rajan retired on the day of Rajan retirement. Value of goodwill is 50,000. So as per the balance sheet, goodwill is 70,000 rupees, and adjustment goodwill is 50,000 rupees. So value of goodwill decrease here by 20,000. Right? Value of goodwill decrease here by rupees 20,000. So if value of goodwill decrease here by rupees 20,000, you have to debit partner's capital account and you have to credit goodwill account, right? Simple. In which ratio, sir? In old profit sharing ratio. Okay. See this one example. Then we'll get conclude. A, B, C are partners in the firm sharing the profits and loss in the ratio of 3:2:1. A, B, C, and they are sharing the profits and loss in the ratio of 3:2:1. B retired. So who is retiring? B is retiring from the partnership from business. Okay. The goodwill of the firm is valued at rupees 60,000, and remaining partner A and C continue to share the profits in the ratio of 3:1. So remaining partner A and C is they are going to share the profit in the ratio of 3:1. General entries pass under the various alternatives. If goodwill raised at full value and written in the books, so whenever we have to raise goodwill, what we have to do? We have to debit goodwill account simply, right? Goodwill account debit to A, B, C's capital account. This 60,000 rupees we have to distribute in their old profit sharing ratio. Done? Any doubt in these? Goodwill raised at full value and written in the books. Any doubt in these? No doubt. Okay. If goodwill is raised at full value and written off immediately, what to do? So you have to raise goodwill in which ratio? In old profit sharing ratio. And you have to write it off in which ratio? In new profit sharing ratio. Whenever you raise goodwill, you have to debit goodwill account and you have to credit all partners capital account. And whenever you write off goodwill, you have to debit continuing partners capital account and you have to credit goodwill account. In which ratio, sir? In new profit sharing ratio. We have already done this. Right? Then, if the goodwill is raised to the extent of retiring partner share written off immediately, yes, sir, we know. You have to calculate retiring partner share only. Retiring partner share in goodwill you have to calculate. Share in goodwill you have to calculate, right? And then you have to pass journal entry. Whenever you raise goodwill, you have to debit goodwill account and you have to create retiring partner share. After that, so they are saying to write off immediately. So if writing off it means what? So writing it off means you have to debit continuing partners capital account and you have to credit goodwill account. But in which ratio, sir, you have to do this? So you have to do this in their gaining ratio. In their gaining ratio. And this is important to understand, right? You have to credit the same, you have to debit the same to the A and C in their gaining ratio, right? Then, so if goodwill is not appearing in the books at all, so whenever goodwill is not appearing in the books at all, you have to simply do what? So you have to adjust goodwill. You have to adjust goodwill as per, sir, as per your gaining and sacrifice, right? Simply you have to adjust goodwill through partner's capital account. So gaining partner capital account you have to debit and sacrificing partner capital account you have to credit. Gaining partner debit and sacrificing partner capital account you have to credit as per their gaining ratio and sacrifice ratio, right? Then, so next and last concept here we have to see is hidden goodwill. What is hidden goodwill? Can you tell me what is hidden goodwill? Dhanushri and Sadhana. What is hidden goodwill concept? Have you seen this before?
Yes, seen it in admission.
Admission of a partner, yes. but forgot. Okay, no worries. So what is hidden goodwill actually? Sometimes what happened, goodwill share, goodwill amount that partner is supposed to contribute is given to you. For example, is contributing 60,000 rupees, but the actual valuation of goodwill is different, right? When you calculate goodwill, so goodwill has to be only 20,000, but he's contributing 60,000. Then it is known as hidden goodwill. Mostly this concept is related to purchase of business. For example, I can say after admission, I'm just revising that admission of partner wala concept. After admission of a partner C into the business, the total capital has to be how much? 5 lakhs. Right? After admission of a partner C, total capital has to be of 5 lakh rupees. But the actual total capital is 6 lakh rupees. So if there is difference between these two things, has to be an actual. So that 1 lakh rupees that you are getting more is only because of the goodwill amount, and that is known as hidden goodwill. Now in this concept, we have to see, for example, I am purchasing business from Dhanushri. So what is purchase of business? So purchase of business is nothing but I will be taking over assets of Dhanushri, right? And I will be taking liabilities of Dhanushri as well. So I have taken over assets worth rupees 50,000 of Dhanushri and liability worth rupees 30,000, right? So it means asset 50,000 I'm getting from her, and there is 30,000 rupees of liability also of Dhanushri on the part of Dhanushri that I'm going to settle, right? So 50 minus 30, so 20,000 is the difference. Actually, this much of amount I need to pay towards Dhanushri, yes or no? I have taken over her asset worth rupees 50,000, and I have also taken over her liability of 30,000. So that 30,000 rupees of liability I need to pay off now. So there are outsiders, there are government taxes that I need to pay. So I will be out of 50,000 rupees of asset, I will be paying off 30,000 rupees of liability, which was on the part of Dhanushri the day before, right? So 20,000 is the only amount that I'm having excess, right? If I took over the business of Dhanushri, then I need to pay 20,000 rupees to Dhanushri as a purchase consideration. It is known as consideration. But if you see, the actual payment done by me towards Dhanushri is 30,000 rupees. Actual payment I have given to Dhanushri is 30,000 rupees. So how much I supposed to pay? I supposed to pay only rupees 20,000, but the actual payment is 30,000. So my question is, why I have paid 10,000 rupees more to Dhanushri? So the simple logic is, so Dhanushri is having name, fame and reputation of her business over a period of years. She was running this business for last 20 years, and I have paid her 10,000 rupees more than it's her net asset. So this answer is known as net asset. Net asset. So I have taken over her assets of rupees 50,000 as well as liability of 30,000. So what is net benefit for me? So net benefit for me is 20,000 rupees. So I supposed to pay her only 20,000 rupees. But actually I have paid how much? I have paid 30,000 rupees. So this 10,000 rupees that I have paid more to her is only because of the name, fame and reputation that she is having over a period of years, that I will be going to enjoy benefit out of that in the future as well when I'm running this business, right? So that 10,000 is known as hidden goodwill. Understood now? And this 10,000 rupees of hidden goodwill we have to adjust. And in case of admission, it's based on capital. In case of admission, it's based on capital. Means, sir, after admission of a partner, they gave you now. After admission, the capital has to be this much, right? But actual capital is somewhat different, more than what is given. So if the estimated capital is 5 lakh rupees, but actual capital is 6 lakh rupees, it is known as hidden goodwill. And 1 lakh rupees you have to adjust to the partner's capital. Understood now? Right? This is one example. Now, this is general example I can say. And this is regarding your admission of a partner. Now, what about in case of retirement of a partner? See, if the firm has agreed to settle the retiring or deceased partner's account by paying him lump sum amount, right? By paying him lump sum account, then the amount paid to him in excess of what is due to him based on the balance in his capital account after making necessary adjustments in respect of accumulated profits and losses and revaluation of asset and liability, etc., shall be treated as his share of goodwill, known as hidden goodwill, right? So if you remember, I have told you, sir, on occasion of retirement of a partner, I need to repay his share of goodwill. Okay, what I need to repay on occasion of retirement, you have to pay back that to retiring partner. First thing is capital balance. His capital balance. Then I need to pay him revaluation profit share. Then I need to pay him, third thing, accumulated profits as well as reserves. Then fourth thing is, sir, capital balance I need to return, revaluation profit I need to pay him, accumulated profit I need to repay him, share of a profit up to date of retirement, share of a profit up to date of retirement, right? These four things I need to pay him. So by calculating all these four things, I'm getting that due amount to that partner is 1 lakh rupees, right? But in the question, suppose it is given to you, actual payment is 1,20,000 rupees. So yes, clearly it is indicating here, you have to supposed to pay how much? Due amount is 1 lakh, but actual payment then is 1,20,000. So you have paid more than what is payable, right? You have paid here more than payable. So that is nothing but 20,000 rupees, right? And why you are paying 20,000 rupees? So it's because of goodwill. So if goodwill is not straight away given to you in the question, it will be given to you like this. So 20,000 is the goodwill amount given to you as a hidden goodwill, and you have to do adjustment for that hidden goodwill now. Understood now? The concept of hidden goodwill, Dhanush and Sadhana, in case of retirement. So I've explained three kinds of hidden goodwill adjustment. Yes. So first in admission of a partner, now in retirement of partner, and general. So general, they will ask you a question in that chapter of change in profit sharing ratio, right? That is in your book, T.S. Garwal book. So in that scenario, you are payable for purchase of business and what is actually you're paying. Okay, see this last question, then we'll stop. And which, like I said you have to pass only one journal entry whenever there is a goodwill adjustment through partner's capital account without raising any goodwill in the books, right? You have to simply adjust through the partner's capital account. You have to find out who is the gaining partner and who is the sacrificing partner. That's it. And gaining partner's capital account, always you have to debit, and sacrificing partner, always you have to credit, right? See, PQ are partners in the firm sharing the profits in the ratio of 3:2:1. PQR 3:2:1. R retired from the business. R is retiring from the business, and the balance in his capital account after making necessary adjustments on account of reserves, revaluation, assets, and liabilities work out to be 60,000. So this R we have to supposed to pay how much? 60,000. Supposed to pay 60,000. P and Q agreed to pay him 75,000 in full settlement of his claim. Sir, but we are going to pay him how much? 75,000. So actual payment is 75,000. Payable is 60,000. So difference here is 15,000 rupees, and we are paying more to him because of his goodwill. Now it implies that 15,000 is our share of goodwill in the firm. This will be debits to the capital account of P and Q in their gaining ratio, right? That is 3:2. If nothing is given in the question regarding gaining ratio and sacrifice ratio, as I said, you have to consider continuing partner P and R old ratio. So their old ratio is 3:1, and this old ratio becomes their new ratio, becomes their gaining ratio as well, right? So we have to pass journal entry for difference between these two, that is 15,000 rupees in the ratio of 3:1 between the partners. So 3:1 will be there. So 3:1 will be their gaining ratio. So we have to debit P and Q's capital account for 9,000 and 6,000, and we have to credit R's capital account for 15,000. Right? Understood? As P and Q are the gaining partners here, and R is the sacrificing partner. He's going out of the business, so he's a sacrificing partner. Understood or not? Dhanushri, Sadhana, tell me. Okay, so we have covered all the concepts which are there in retirement of a partner, right? So far. And from the next session onwards, we are going to solve practical questions, right? On each and every, based on each and every concept or mix of all the concepts together. Understood? So do revise this session. This session is very much important. In the last session, we done calculation of new profit sharing ratio. I'm just revising here what I've done so far, right? Just 2 minutes, I will be taking off yours. So first concept that we studied is calculation of new profit sharing ratio, then gaining ratio, right? Then we understood, sir, revaluation concept, revaluation of asset and liability. Then third, we understood, sir, concept of accumulated profit reserves and loss, right? Fourth, we understood, sir, profit share of retiring partner till the date of retirement of a partner, right? And fifth, we understood about goodwill adjustment. As I said you, in a goodwill adjustment, there are only two concepts which are there in your CBSE syllabus. So second is hidden goodwill and goodwill adjustment through capital account. In that case, you have to find out who is the gaining partner and who is the sacrificing partner. That's it. Right? Rest of the thing, raising of goodwill, writing of goodwill already appear in the balance sheet, right? Then you have to adjust that. These things are there in your CA foundation, not in your CBSE syllabus. In CBSE, only two things: goodwill adjustment through the capital, that is gaining partner, sacrificing partner, and hidden goodwill. Understood?